Hello, ladies and gentlemen, and thank you for joining me, Charlie Morris, for the Bitcoin and Gold in 2024. And I hope that we'll conclude by understanding you're better off in gold. So before we kick off, a little bit of administration, and we've got, why does my slide not work? We've got a little bit of compliance to go through. Obviously, Bitcoin's a very, very excitable asset class, so please don't go and pile in aggressively after this presentation. The whole point of Bitcoin and gold is to calm things down. So who am I? Well, I've been in the financial services industry for 25 years. I joined HSBC in 1998, HSBC Asset Management. I set up and ran their absolute return service. It was a multi-asset portfolio, way ahead of its time, and it was some very, very many good years. And set up ByteTree after that. Left HSBC in 2015. Did a few things in the city of London, and basically set up ByteTree. And what we do here is mainly investment research in gold and Bitcoin and multi-asset, bonds and equities, that kind of stuff, commodities, and crypto. And we have a lot of fun with a lot of different product offerings, and our clients seem to like what we do. We also have a Bitcoin and gold ETF, which I won't be talking about today, but you can look that up in your own time should you wish to. But we're going to be talking about the strategy of Bitcoin and gold and the outlook for the two asset classes in 2024. We'll kick off with gold. And I think that gold is probably more interesting right now than Bitcoin, and probably that will become obvious in the next half an hour why. But I think the simple answer is that Bitcoin's had one hell of a run this year. And also it's been good macro conditions for most of the time for Bitcoin. We've had the bond yield going up, and we'll come to this as well. But that really favors Bitcoin over gold. And now it's going down, and that will favor gold over Bitcoin. But there are other factors too, and hopefully we'll get to them. So, quite fun to look at the stock to flow ratio. Now, this is the stock to flow ratio of gold going back to the 17th century, and if you look at that spike in the middle, no prizes for guessing when the gold rush happened in the Americas and also in Australia. And at that time, there was a lot of gold explored, and so the stock to flow ratio went very, very high, and basically that came down as gold became scarcer, as that boom kind of ended. But what you've got is a stock to flow ratio of 50, which is another way of saying you've got 2% annual supply growth. So if you have 100 tons of gold and you mine 2, then 100 divided by 2 is 50, stock to flow 50. So it's a very simple idea, and a big number deems an asset to be quite scarce. There's a big above ground supply, and the amount of new supply is quite low. So we tend to think of stores of value, alternative assets, as being pretty calm and robust when we've got a high stock to flow ratio. But it's just a fancy way of saying supply growth, and we'll look at Bitcoin later. So the key point there is that it's 50. Now, the next slide is really looking at the model that I've been using for a long time. And this is the TIPS model, and it compares the price of gold to 20-year TIPS. Now, TIPS are US inflation-linked bonds. They're 20 years because there's a volatility match, and the volatility of gold is approximately the same as 20-year bonds, not 10 or 30. 10-year bonds are too calm, and 30-year bonds are too volatile. And there's been a sort of discount premium on that relationship. The correlation, the daily moves, is extremely high, and always has been and continues to be so. But I think the mystery of gold in the last 2 years is why gold has held up and just recently made an all-time high, and had one hell of a move last night on the Fed comments. And yet the TIPS model has gone down. So TIPS are now offer really good value compared to gold, but they did, when TIPS collapsed in 2013, it pulled the gold's price down. But this time it hasn't happened. And the question is why? And this is something I've been writing about in Atlas Pulse all year, trying to find those answers. I'll come to that in a sec, but before we go there, we shouldn't really worry too much about the fact that that model has diverged. It does tell us really that tips are good value and that's fine, but they haven't started moving yet. For them to move, we need either rates to come down or inflation expectations to go up, which hasn't yet happened. But what we can see here is every time there's a rate cutting cycle, gold has a new bull market. And so, we've had the pain over the last 2 years of rate hikes. Gold hasn't gone down; it's held its own in that time, which is very impressive. And at the end of it all, we've now got rate cuts to look forward to, we think, and that should be very bullish for gold in 2024. The other thing is that we had this war in Ukraine. And that really changed the world. It wasn't the war so much, it was the confiscation of Russian reserves, US Treasury bonds. And the outcome of that is that if you're owning lots of reserves for your country, suddenly gold becomes very, very appealing compared to US Treasury bonds, because gold, if you have in your possession, you need a major invasion in order to confiscate it. So that has made gold much more popular with the official sector. So the central banks of the world were selling gold all the way through the 1980s, 90s, particularly in Europe in the 1990s and the UK notably. And then it carried on really till 2008, the financial crisis. And it was after that when people woke up and said, well, actually, maybe the financial system does have risks that we hadn't anticipated, and they all started to accumulate, particularly in the emerging markets. So we've seen record inflows from the official sector in the last year, and this really has underpinned the market, changing the calibration of the tips model that we saw. So gold and tips still move up and down together, but there's a calibration change, and I think there's different ways to explain it. But we'll get to money supply in a second. But before we get there, just looking at rates and inflation, which are a very, very important part of the gold market, we've got real interest rates in blue, which are comprised of the 10-year yield in this case, and the break even. The break even is the inflation expectation, and that's basically 2%. And it's always 2%. It goes down a bit, then it goes up a bit. And it's extraordinary. In the last couple of years, we never saw the surge in break-evens that I think a lot of people in the gold sector expected to see, given that actual inflation had got out of control. So the black line's gone up a lot, from record low bond yields to something much closer to normal. Inflation has barely changed on the 10-year expectation, but the real interest rate has gone from negative territory to positive territory. And the miracle for the gold watchers is this has not caused a major gold correction in the last couple of years. And indeed, I think the risk is now behind us. So there are other factors that we can look at for valuing gold. One is this idea of the money supply. That is 1960 to present. 1960 to present, when we've got 7% average analyzed growth of the money supply in the United States. And gold has been undervalued and overvalued at various times. 1980, massively overvalued on this model, undervalued in 2000, overvalued in 2011, and undervalued today. And notice also in the red line how the US money supply has been falling in the last 2 years. And so that would be a downward force on asset prices and on gold. And indeed, that was true in 2022. Asset prices went down, but this year, 23, they've been going up again. More recently, we've been able to compile global money supply data, and this goes back to 2003, and it's a much better fit because just because the US isn't necessarily expanding the money supply doesn't mean that someone else isn't. And assets like gold and indeed Bitcoin, it doesn't really matter where the money's being printed, provided it's being printed somewhere, because it all finds its way around the system. And right now, on this basis, gold's about fair value with the global money supply, which has been pretty low in terms of growth for the last 2 years, despite a 7.3% trend over the longer term. And, I think that is important, that we say that it has been flat for the last couple of years, which means it's going to carry on rising again soon, and that's going to be pretty powerful for the gold price. An increase in the money supply is going to be the thing that underpins the next bull market. And as I said, the global G20 money supply coming from the top countries, in the dashed line, the red line in the middle, that's the global aggregate. But the top blue line, that's China. And so, thank you, China. You're printing money, whilst many other countries are not. And that's where it's coming from. So, the Chinese are going to save the day for the alternative assets in the coming year. And of course, the US will start printing again soon, along with the ECB. So we move on to Bitcoin, and I think that Bitcoin basically is digital gold. Years ago, I never believed it when I first came across Bitcoin. I thought, well, it can aspire to be, it can try and do it, but I didn't think it would probably work. But it looks like it's working, which is a real surprise. And it's becoming more and more liquid and more credible and more widely owned. And it's just becoming increasingly part of the global financial system. Now, there's a huge amount of official hatred towards Bitcoin. So, for example, the regulators are very wary of it, and they need not be, because the blockchain is open and transparent. It's publicly available information. But what they don't like about it is they can't control it, because Bitcoin doesn't have a CEO or a board of directors or even an office or a phone number or anything. And that's the genius of this whole system. If it did have any of those things, then it would be absolutely pointless. And so when you read a note from some clueless dimwit in the city of London who talks about, if the crypto could be, more ESG and, more, have more accountability, well, then, that's a bit like having gold that could be reproduced in a vending machine or something. It's got to be rare, and it's got to be autonomous, and it's got to be decentralized in order to be the asset that everyone wants to trust. And that's a very important point. So we've now got the stock to flow ratio of Bitcoin, which was very low a few years ago when it started. The rate of inflation of new supply was very high, but it's becoming crashing down every halving period. And the halving periods were 2012, 2016, 2020, and then next April. The middle of April next year, we expect to see the next halving. And so that means the stock to flow ratio, which in the high 50s, remember gold was 50, means that Bitcoin's basically new supply is about 1.8% per year. Next year, it's going to go to 0.9, or a stock to flow ratio over 100. And so some people are getting really excited about that. And probably they should do. But the important point is that many cryptos can do this, but only Bitcoin's worth the amount of money it is. It's 52% of the entire market, which is huge. There's a massive bit of Bitcoin dominance. And I'll address in a second why the fact that there are 10,000 copycats with the same stock to flow dynamics as Bitcoin have no value. Only Bitcoin has the value, because you have the supply, and the stock to flow ratio basically deals with the supply, but then you have demand. And demand's much harder to cook up with a bit of computer code. You actually need to motivate the world, create a brand, and make sure it's widely owned, traded, supported, and all the rest of it. And Bitcoin has that, and the other crypto type source of value do not have that. And the red line in this chart is basically a simple model we created many years ago, which looks at the amount of dollar traffic that goes across the blockchain. And it's very simple, that if the Bitcoin blockchain has got $40 billion a week transferring across it, then roughly speaking, Bitcoin's worth $40,000. It's not exactly that, but it's not a bad rule of thumb. And what I like about that line, the red line, is it's rising. So provided the red line is rising, the network is growing, and that's generally speaking pretty bullish for Bitcoin. If you just owned if you owned Bitcoin when the network was expanding over the last 10 years, then you did pretty well, and you avoided the bear markets, because we've always seen a contraction in the network during Bitcoin bear markets. So we all know that Bitcoin's really volatile, don't we? It's one of those things that regulators talk about in their warnings and all the rest of it. Really scary. But actually, it used to be really volatile. So 10 years ago, we were talking about sort of 100% volatility and what have you. But now I've plotted it there against the 7 largest companies in the world, the Magnificent Seven. And the most volatile there is Tesla, and then we have Nvidia, and then we have Meta or Facebook, and they're the most volatile. Then we have the blue one is Amazon, and Bitcoin comes in just slightly less volatile than Amazon. And then we've got Alphabet, which is otherwise known as Google, and then Microsoft and Apple, which are less volatile. But basically, it just shows you what an exaggeration it is that Bitcoin's really volatile and really dangerous. The way it behaves is not much different from many blue chip stocks. I strongly believe it's not much more volatile than an oil company or a bank or something like that. in terms of the investment experience of holding it long term. Obviously, it has appreciated much more, but that aside, really, when we talk about volatility, we're really referring to the risks as opposed to the rewards. And I think the other point about crypto at the moment is that Bitcoin's going up, supported by the top 100 coins. So blue means this is our ByteTree or ByteTrend.io breadth indicator, and it goes back a couple of years, and it's basically saying when there's lots of blue, most crypto tokens are going up in terms of the 200-day moving average and 30-day moving average. All positive, prices are above those, upward sloping and that kind of thing. And when there's lots of red, you're in a firm bear market. And it does look pretty clear to me that the bear market's over in crypto, but it's retreating, and there are basically hardly any downtrends at all, and there are a growing number of uptrends. So that's bullish, and that's likely to last for some time. And as I said earlier, we've also got the halving coming next year, in addition to things like the ETF. But we posed the question a moment ago about Bitcoin copycats, about the 10,000 cryptos that have copied the code, which is fine, but they can't create all the demand that's required. They can't make it globally recognized and accepted, and the brand name and support and all the rest of it. Nor can they create the security of the network. And the miners' revenue, the annualized miners' revenue, and of course Bitcoin is supported by the mining community, their revenue's just gone back above $10 billion per year. And that's a hell of a lot of money. And that is what underpins this asset that's on its way to $1 trillion of value. Right now, $10 billion is about 8% of the value of all the Bitcoins in circulation. That number will come down, but the miners get very well paid, and this is super secure. So the joke is, if you wanted to actually sort of surpass Bitcoin somehow and recreate it, well, one of the things on your to-do list is $10 billion a year of mining power, which is a pretty hard thing to fake. Or, well, not hard, just expensive. Anyway, so my observation a few years ago, because I've been studying the gold market since 1999, I've been writing about it for 11 years now in Atlas Pass, and Bitcoin, I came across it in 2012, thought it was ridiculous, and then came back in 2013 and thought it was amazing. So I figured out what the blockchain was. For me, the penny drop moment was the Bitcoiners didn't have serial numbers on them, but they had provenance. And this is the idea that they come from a blockchain, and you can you can see what it's a bit like a family tree. You can see where they came from, and that's how you prove a Bitcoin's a Bitcoin. Because if you think of it mentally as having a serial number on a computer, well, you can just cut and paste it, and that clearly wouldn't work, would it? So you've got this situation where you really have solved the problem that computers found difficult to solve. Because I think the way I see a blockchain is it's kind of a computer code interacting with humans. Whereas most computer code just does something you ask it to, or with AI it does something you didn't ask it to. But at least in this case, it really is coinciding with this idea of having assets, digital assets, and that's a very powerful force, and it's only going to grow from here, whatever regulators think or dream of how the world will continue. So Bitcoin plus gold is bold, and my view is that they're better together. So the first point I was going to make is that they've both got the limited supply, which is a good thing. Bitcoin was built around the idea of gold, and that's fine, that's a supply, but the demand has come. And as a result, these are the two most liquid alternative assets in the world. So Bitcoin's about 3 times more liquid than silver, and it's way more liquid than any other crypto. So I think when it comes to store of value, why bother diversifying away from gold on the metal side? If you had oil, that would be futures contracts. That's a financial asset, not an alternative asset, in my opinion. Real oil in a barrel, but that's not exactly practical. Art and these things, they're not liquid assets. Ethereum and all the rest of it, they haven't won. Bitcoin has won. It's the monetary asset within the space. So putting these two together is very, very effective. And as you'll see shortly, there's a kind of a rebalancing situation. So if you rebalance your portfolio on a regular basis, you add value. Don't worry about that yet. We'll get to that. And we're gonna do that by crossing over the volatility. So basically, the more volatile asset gets less exposure. And this is a simple thing that's been happening in finance for years, rebalancing of and risk weightings, and it adds value, which is why a lot of the big pension funds do it. Between not between Bitcoin and gold, but between bonds and equities. And so anyone who's been buying bonds after they've gone down a lot and selling equities after they've gone up a lot, that's a clever thing to do. And we've got a little quote here from Ray Dalio. There are a few of the financial stars around the world who are picking up on this idea. And he said, I would take the gold and I would sprinkle a little bit of Bitcoin into that mix too. But we've got even better stars in finance talking about Bitcoin and gold these days. But of course, Charlie Munger is not one of them. Bless his soul. So this is the model I've been using for a long time. It is a very simple idea, and basically you can split most assets into into these sort of four groups. Going up is inflation, going down is low inflation or deflation, and to the right we've got risk-on conditions, expanding economy, rising bond yield, and to the left we've got risk-off, a falling bond yield, contracting economy. And what does best in each environment? And below the line we've got high quality equities, which are bond-like, and bonds themselves, mainly government bonds, risk-free bonds. And then on the other side, the risk-on side of low inflation, we've just basically got the stock market, so growth equities and that kind of thing. And think of these companies that the value is in the people as opposed to in the assets. And above the line, in risk on, we've got value and Bitcoin. And by value, I kind of mean the value is not in the people so much, but in the assets. So we're talking about oil rigs and heavy industry, and even a bank would fit into that category, because a bank, what's its. I used to work for HSBC, and the joke was that the employees weren't anything, but the HSBC was valuable because it had all the money, and it's the bank with all the money. And on the other side, in the risk-off situation, we've got gold and we've got tips. We obviously know those go together because of our tips model we saw earlier. And if you balance between these four things, it doesn't really matter what happens to bond yields and to inflation, but you should be suitably diversified. So that's a pretty strong position to be in. So it occurred to me that if we put gold and Bitcoin together, we'd have put together the world's two most liquid alternative assets, and they would sit together and they should fit like a glove, whether the bond yields are going up or whether they're going down, whether it's a recession or whether it's a boom. One of them's gonna help out the other one in some kind of relay pass the baton situation. And the way you put them together is using inverse volatility. So as I said, Bitcoin's volatility used to be really high on the left when it was just recently launched, 160%, which is just crazy. But today it's below 40. So it really is in line with mainstream blue chip assets. Still a little bit on the high side, but high quality equities, Unilever, Diageo, Johnson & Johnson kind of things, that they're in the 20s or low 20s or the high teens. But it's much lower than commonly perceived. I think that's the point. And then gold is typically historically 18% right now. It's a little bit lower than that. So we now have to put on our clever cap and think about how we're going to do some high-end mathematics to work out how to make our bold portfolio. So we're going to plug in, and we can do this once a month. We have to have a big cup of coffee on the last day of the month and think about things from a mathematical perspective. We put in the volatility. And then we go 1 over, so 1 over 38.8 is 2.61, 1 over 13 is 7.69. We add those numbers together and we get the magic number, the blue one, 10.3. And then we just take those two numbers that I just described, divide by 10.3, and out come the weightings for the amount of money we have in Bitcoin and gold for the following month. Phew, hard maths is now over. We can carry on. And it's a discipline to keep doing this every month, because it could be that Bitcoin starts the month at 25.3, but then does very well, and it could easily end the month at sort of 35, or it could do badly and end the month at 15 or something like that. But that process of constantly keeping the risk in line is very beneficial over time, as you will see. Here's a little graphical illustration of that. So imagine we've got Bitcoin over monthly moves, going up a lot or down a lot, and gold's basically doing something different. Either it's negatively correlated, or it's occasionally in the same direction, but to a lesser extent. Basically, the correlation between Bitcoin and gold is zero. Yeah, sometimes it's uncorrelated, sometimes it's slightly correlated, but it averages out at zero, and that's perfect for a diversified portfolio. You don't want the assets to be correlated, otherwise they're just doing the same thing. Now, if in this example, I'm going to haircut Bitcoin by 80%, so I'm only going to have 20% in Bitcoin, and I'm going to haircut gold by 20%, and the result is on the bottom chart. And it's very simple that if you don't own 100% Bitcoin and 100% gold, which is the top chart, and you own the bottom one and reduce them, risk weight them, then the whole thing becomes a very calm affair. You don't need much Bitcoin to make a big difference. That's the point. And if you rebalance it every month, then you add quite a significant amount of additional value. The Bold Index, we've calculated back to 2015 actually, but since 16 here. And you can see the weight of Bitcoin in gray, and you can see the weight of gold in gold. And when Bitcoin's been particularly volatile, its weight's come down. Very simple as that. So in the 2017 surge in Bitcoin, the weight was coming down, which would have hurt performance, absolutely. But by the time 2018 came, Bitcoin was down to 10%. So that was fantastic, because a bear market with 10% exposure is pretty good. And now we've got Bitcoin coming down to the record levels, record low levels of volatility. The exposures, the weighting's now back above 25%, 25.3 as at the end of November. Now let's look at this one. This is a very simple idea of visualizing why rebalancing works. And we've got a hypothetical investor who's got $1 million, and he goes and buys some Bitcoin and gold at the beginning of 2018. And he's had his cup of coffee at the end of the month, and he's got his mathematical brain in gear. He's done the calculation. He's got the weight, the optimized weight, and he starts off and he goes and buys a big pile of a couple of hundred Bitcoins, and he goes and buys 1,700 ounces of gold. Now in 2018. The price of Bitcoin's falling quite aggressively. So every month in this rebalancing, he's actually increasing his exposure to Bitcoin and selling gold in order to do it. By the end of 2018, and Bitcoin has bottomed by this stage, and it starts to rally quite aggressively from 3,000 up to about 13,000 in kind of May 2019, something like that. And the reason he's done well is because he had loads of Bitcoin at the bottom of the market, could have been buying through the bear. Got his money back very, very quickly indeed, and now he's going the other way. Bitcoin's going up, and every rebalancing, he's selling Bitcoin, he's buying gold. Then a Bitcoin bull market comes along in 2020-21, a very strong bull market. Didn't last long, but it was pretty strong. And he's selling Bitcoin, he's accumulating gold. In fact, his number of ounces, if you look at the 6-year period, the number of Bitcoins doesn't change much. It's down a bit, but not hugely. But the number of ounces of gold really goes up quite a lot. He starts off 1,700 and he ends up with 2,500. And this happens again in the Bitcoin bear market of 2022, when basically as Bitcoin's falling, he's doubling the number of Bitcoins in the portfolio by the end of 22. So at the beginning of this year, rather than having a small amount of Bitcoin, 7% of the portfolio, so 720 down to 7 after the fall, he's actually got quite a lot. So you open the floodgates. Bitcoin bull market up 150% this year, and he's got loads of Bitcoin to benefit from that. So he make an all-time high much more quickly than you expect. And that is why Bold is such a powerful combination. If in this slide, it's a 6-year slide, and it goes back to the 17th of December 2017, when Bitcoin had its all-time high at the time of just under $20,000. And since then, you could have owned Bitcoin 20,000 to 3 to 13 to 5 to 64 to 30 to 68 to 16 and to the current number of just over 40,000. You could have had that extraordinary ride, which would have been difficult for a lot of people to sleep, and it would be difficult to hold on to Bitcoin for all that time. But in the 6 years, Bitcoin is actually up not nearly as much as you think. It's up 126%, which is the same as Bold. And gold, most of that Bold portfolio, the average weight would have been below 20% because of the bear market periods, and the gold only went up 62%. So how the hell did Bold do so well when it actually only had a small amount of Bitcoin and lots of gold? And the answer is the rebalancing transactions. Absolutely crucial. And you're not milking this pair or managing your risk if you don't do them. So, we publish the data free of charge. The world can help themselves to the Bold rebalancing data. And, it's a very supportive force for Bitcoin, because, what we're not doing is buying breakouts and adding to the volatility. We're buying dips. And so we're actually decreasing Bitcoin's volatility by being a value investor in this strategy. Here's another illustration of performance. This is just 5 years to today. And the interesting thing about Bold is it's made an all-time high when the other assets haven't. So Bitcoin, I've taken Bitcoin off this chart because it ruins the chart, and I'm now showing Bitcoin again. Bold against the Nasdaq index in green, gold's in gold, and the global equity index capital return is in red. And it's the only thing that's managed to make an all-time high. And the last high was at the end of 2021, at the last Bitcoin peak, which drove that. And I think it's pretty impressive that it's done that, and it's been making all-time highs, for the last few weeks. It's been steadily making progress. And today, we did see Bold sell off a couple of percent, but then just today, following the Fed announcement last night that basically rate hikes are behind us, Bold straight back to that all-time high when Bitcoin isn't. So I think that there's a real case that for the gentleman investor or lady who wants to have a smooth ride, but embrace crypto in a sort of sensible manner, to embrace this concept. Moving on to the volatility. So this is 360-day volatility, which is my preferred measure. 30-day volatility is great for sort of tactical trading and trying to be clever. But I think if you just want to assess an asset's quality over the longer term, then 360-day washes out a lot of that stuff. And what we see here is that gold's got a volatility that's pretty low, below 15, and Bold really is a tiny bit more than gold. And that's despite having a quarter of Bitcoin, because of the non-correlation. If it was simply a matter of saying, well, 75% gold at this volatility and 25% Bitcoin at that volatility, the weighted average is whatever, then that would be a volatility much higher than the Nasdaq. But in this case, it's not, because it just shows you that the two naturally diversify against each other, and that's why the volatility of Bold is much lower than commonly perceived. Bold is about the same as global equities in red, and materially lower than the Nasdaq. So if you remember the last slide, we showed that basically Nasdaq and Bold have a very similar outcome, but Bold's much less volatile. I also think that the Nasdaq is a bubble. It's a historic mega bubble. It's got huge concentration in stock market indices, and many of the companies, particularly things like Apple and Microsoft, are stupendously overvalued. And Microsoft, people forget that it fell 75% in the dot-com bear market. It can do it again. And Apple shouldn't be on 30 times earnings when it doesn't grow. That doesn't make any sense. So there's a few $1 trillion of money that's going to be lost in financial markets, courtesy of the big tech stocks. And I think Bold is the carry-on trade. So you can switch from the idea of Nasdaq to Bold, and you're avoiding a bubble. You're just carrying on with a sort of all-weather defensive asset. And a couple of slides left. I think this one's really quite interesting. What drives Bold? And we talked about the money supply earlier, and this is the global money supply, and it just fits like a glove. And Bold started going up a few weeks ago, and just recently the money supply then turned. So it was a quite interesting leading indicator in this case. And I suppose you could look to the 2022 drawdown, which was a little bit more than the drawdown in the money supply, in contrast to 2018, which was about the same. And I suppose that the scandal with, Bankman-Freud and that sort of thing probably took Bitcoin a little bit lower than it needed to go. But nevertheless, that fit is extraordinary. And the money supply might grow at 7.3, but the Bold index, we need different scales here, because the Bold index against the money supply of $102.9 trillion it goes up about 3 times faster, 3.5 times faster. So Bold has been trending at about 25% or so over the last few years, and that's about 3.5 times the money supply. The way I like to think about it is that Bold is paying you the money supply once for the gold, once for the Bitcoin, and once for the rebalancing. It's a very sort of simple mental model of why it's so good. And in conclusion, Bold brings together the world's 2 most liquid alternative assets. The monthly rebalancing is essential. We have the weights according to their relative risk. And Bitcoin's much more is the most established of all the crypto assets. It's 52% of the total crypto market. So complete dominance. It's one. There is no competition. Bitcoin has no competition within crypto. The rest of them are killing each other. They're eating each other's lunch. They're competing like companies do. But Bitcoin is a cut above the rest. And gold has got the history. It's got the 5,000 years, and it's owned by the world's central banks, and it's a very, very credible long-term store of value. Rebalancing minimizes the risk. It maintains the risk and helps deliver some additional return. The data is available on the Bold piece that we send out once a month on ByteTree.com. It's a powerful combination, and we believe it's going to offer good inflation protection over the long term. Now, there was a very, very funny moment on Twitter the other day. I don't know if you know Merrin Somerset Webb's podcast. At the end of it, she's a Bloomberg reporter. At the end of it, she always asks the interviewee, "Do you like Bitcoin or gold or cash?" And obviously, her natural audience will have all selected gold, but obviously the Bitcoiners got the upper hand on this one and piled in and made their claim. But I love the comment, from Walker, who says, "Gold, you own gold because you want to maintain your purchasing power. Bitcoin, you want to increase your purchasing power, and cash, you want to decrease your purchasing power." And I just think you put it so well, and really sort of nailed it. And so what we're doing is we're trying to increase our purchasing power with a bit of Bitcoin, owning the right amount on a risk basis, and rebalancing with gold so we can store the profits we make over time. And that's the address of our various publications that are relevant to this. We do other things as well, but Atomic is all about Bitcoin, Atlas Pulse is all about gold, and Bold is the rebalancing piece. And the index is created by Vinta, based in Stockholm, and they've got some information on their website too.